Have you ever heard the saying, "Don't put all your eggs in one basket"? It's a pretty common idiom, but it holds a ton of weight when it comes to your finances. Today, we're going to break down what diversification really means, why it's so important, especially for those of us in the US, and how you can actually implement it in your own investing strategy. So, what is diversification? Simply put, it's the practice of spreading your investments across different asset classes, industries, and geographic regions. Instead of concentrating all your money in one stock, one bond, or even one type of investment, you distribute it among a variety of options. Think of it like building a well-rounded portfolio, not a collection of highly speculative bets. Why is this so crucial? Well, let's consider what happens if you do put all your eggs in one basket. Imagine you invest your entire life savings in the stock of a single company, let's say a tech startup. If that company thrives, fantastic. You could see significant returns. But what if it fails? What if a competitor emerges, or the product doesn't gain traction, or there's a sudden scandal? You could lose a substantial portion or even all of your investment. That's a huge risk. Diversification helps mitigate that risk. If one investment performs poorly, the others can potentially offset those losses. It's not about guaranteeing profits. No investment strategy can do that. It's about reducing the impact of any single investment's failure on your overall portfolio. Now, why is this particularly relevant for us in the US? The US economy, while generally strong, isn't immune to downturns. Certain sectors can be heavily impacted by things like changes in government policy, global events, or even shifts in consumer preferences. Plus, we're exposed to risks like inflation and interest rate fluctuations. Diversification helps protect you against these specific US-based economic challenges. Let's look at some simple examples of how diversification works. Imagine you have $10,000 to invest. Scenario 1. You put all $10,000 into stock of Tesla. If Tesla has a great year, you're thrilled. But if Tesla's stock price drops due to competition or production issues, your entire investment suffers. Scenario 2. You diversify. You allocate $2,500 to Tesla, $2,500 to an S&P 500 index fund, which spreads your investment across the 500 largest US companies, $2,500 to a bond fund, and $2,500 to international stocks. Now, if Tesla struggles, the other investments can help cushion the blow. The S&P 500 fund provides broad market exposure. The bond fund offers stability, and international stocks add diversification outside the US market. It's not just about stocks and bonds either. You can diversify within asset classes. For example, within stocks, you can invest in large-cap companies, small-cap companies, growth stocks, and value stocks. Within bonds, you can invest in government bonds, corporate bonds, and municipal bonds. Real estate is another great way to diversify. You can invest in real estate investment trusts, or REITs, which allow you to own a piece of various properties without directly buying and managing them. Commodities, like gold or oil, can also provide diversification benefits, as their prices often move independently of stocks and bonds. Another layer of diversification comes from geographic region. Don't just invest in US companies. Consider investing in international markets like Europe, Asia, and emerging markets. This can help you capture growth opportunities outside the US and reduce your exposure to the risks specific to the US economy. Think about different industries too. Don't load up on tech stocks alone. Spread your investments across sectors like healthcare, energy, consumer staples, and financials. Different industries perform well at different times, so diversification helps ensure that your portfolio isn't overly reliant on the performance of a single sector. Now, it's important to understand that diversification doesn't eliminate risk altogether. It reduces unsystematic risk, which is the risk specific to a particular company or industry. However, it doesn't protect you from systematic risk, which is the risk inherent to the overall market. For example, a major economic recession would likely impact all asset classes, even a diversified portfolio. So how do you actually implement diversification? One of the easiest ways is to invest in exchange-traded funds, or ETFs, and mutual funds. These funds are professionally managed and typically hold a diversified portfolio of stocks, bonds, and other assets. They offer instant diversification at a relatively low cost. You can also build your own diversified portfolio by carefully selecting individual stocks, bonds, and other assets. However, this requires more research and ongoing management. Consider your own risk tolerance, investment goals, and time horizon when choosing your investments. If you're not sure where to start, consider working with a financial advisor. To recap, diversification is about spreading your investments across different asset classes, industries, and geographic regions. It's a crucial strategy for reducing risk and protecting your portfolio from the impact of any single investment's failure. While it doesn't guarantee profits, it increases your chances of achieving your long-term financial goals. Remember to consider ETFs and mutual funds for easy diversification, and always assess your own risk tolerance and investment objectives. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.